In 1967, a man bought an insurance company for $8.6 million. 6 years later, that money was back in his pocket. Not from profit, not from selling it. He used the insurance company's own money to buy back his own money. Legally, and every insurance company on earth could do the same thing. Almost none of them do. This is the trick Warren Buffett has used for 60 years. And by the end of this video, you'll understand it better than most fund managers do. Here's the part nobody tells you about Warren Buffett. He's not just a stock picker. Stock picking made him rich. This, the thing behind that vault door, is what made him the richest. It's called float. And once you see how it works, you'll never look at an insurance company the same way again. Insurance is a strange business. You pay a company money today for a promise they'll pay you later. If your house burns down, if you crash your car, if you get sick. Here's the strange part. Most people who pay never file a claim in a given year. So the insurance company is sitting on a giant pile of cash it hasn't paid out yet. That pile has a name. It's called float. And float isn't the insurance company's money. It's not really your money either. Not yet. It sits in the middle, waiting. Buffett's genius wasn't inventing this. Every insurance company has float. His genius was realizing what you could do with it while it waits. By 2023, Berkshire Hathaway was sitting on over $160 billion of float. That's not revenue. That's not profit. That's money Buffett got to invest for free before he had to give a single dollar back. So how do you turn money you're holding with someone else into money that buys you an empire? That's where it gets interesting. In 1967, Buffett bought a company called National Indemnity for $8.6 million. On paper, that looks like a normal acquisition. Buffett hands over cash, he owns the company. Simple. But here's what actually happened. National Indemnity wasn't just a business that sold policies and collected premiums. It came with something extra. A pile of float. Money policyholders had already paid in, sitting there, waiting to cover future claims. That float alone was worth a huge chunk of what he paid to buy the company. So the real math wasn't, I spent $8.6 million. It was closer to, I spent $8.6 million and got back a war chest of investable cash almost immediately. Buffett didn't just buy an insurance company. He bought a machine that generates cash he doesn't have to repay quickly, and he immediately pointed that cash at more investments. He used the float from National Indemnity to buy stock in other companies. Those companies grew. That growth became his growth, funded largely by money that technically belonged to policyholders, sitting there, waiting. He never paid full price because the asset partially paid for itself the moment he owned it. Once you see this pattern, you start seeing it everywhere in Buffett's career. Here's the loop. Step 1. An insurance company sells policies, collects premiums. Step 2. Most of that money isn't paid out right away. It becomes float. Step 3. Buffett invests that float in stocks, bonds, and entire businesses. Step 4. The returns from those investments make Berkshire bigger and stronger, which lets it buy more insurance companies, which creates more float. It's not a one-time trick. It's a self-feeding loop. And every rotation, the amount of free money grows. Now, before you go start an insurance company this weekend, there's a catch. A big one. Float isn't actually free. Comes with a price tag most people never think about. If an insurance company pays out more in claims than it collects in premiums, the float isn't free anymore. It's expensive. You're essentially borrowing money and paying interest on it, except the interest is your losses. This is why Buffett has obsessed over something most investors ignore completely: underwriting discipline. He was famous for walking away from business. If a market got too competitive and insurers started underpricing risk just to win customers, Buffett would let Berkshire's insurance premiums shrink, sometimes for years, rather than write bad policies. Other insurers chased growth. Buffett chased cheap float. Float that cost him nothing. Or, in Berkshire's best years, float where he was actually paid to hold it, because premiums exceeded claims. That's the difference between an insurance company that builds an empire and one that quietly goes bankrupt. Here's why this matters more than people realize. If you invest your own savings, you compound one pile of money. If you invest float, cheap float, from disciplined underwriting, you're compounding a pile of money that keeps refilling itself from premiums, on top of the returns you're earning from investing it. It's not just growth. It's growth on top of a growing base. This is arguably a bigger driver of Berkshire's success than Buffett's stock picks themselves. The stock picks were good. The float made them powerful. Buffett repeated this playbook again and again. Geico, General Re, dozens of smaller insurers folded into Berkshire over decades. Each acquisition wasn't just buy a company, collect the profits. Each one was buy a float generator, then go invest that float better than almost anyone alive. Some of Berkshire's most famous stock holdings, Apple, Coca-Cola, American Express, were bought in part with float that started as some stranger's car insurance premium decades earlier. He didn't just buy an insurance company in 1967. He bought a machine that's been quietly funding his empire for almost 60 years. And most people who own insurance stocks today still don't understand what they're actually holding. If you want the next part of this story, how Buffett almost lost this whole strategy in the 1970s, and the mistake that nearly wiped it out, that's coming next.